Welcome back to Soulful Academics, where I teach you guys how to budget, save, and invest. I got something very special for you guys today. Stock market course for beginners, starting from knowing zero knowledge experience to being a very professional. So now let's get straight into the video. Make sure you guys like, comment, subscribe, and make sure that you comment your favorite part of this video, what part that you currently are having more questions about. Let's get straight into the video. What is a stock? Stock is ownership of a company traded by the New York Stock Exchange, Dow Jones, and NASDAQ. So if I got a public company like Walmart or Costco, then I can put that on exchange where people can buy my stock and invest in my company without having to physically or add any innovation or anything that requires a company to expand. I can just buy a part of that company and own shares. What type of stocks exist? We have energy stocks, we have materials, we have industrials, we have consumer discretionary, we got consumer staples, real estate, healthcare, financials, information technology, telecommunication. So all of these different parts add to the stock market, and they have different sectors where you can invest in. And it's the same thing with the economy. Different economies have different careers that people make towards accumulate the total economy based on these careers. So we got information technologies, example, is one of the biggest sectors of the economy. So how technology and how we interact with these different type of careers always, most of the time, goes through technology, and we keep up with it through technology. Because whenever we got to store information, it hits a database where they store this or where we can pull information from it. It's easier nowadays than you have to physically write it on paper. Now we design homes with technology. We add healthcare and we add technology to that. So we got industrials, we got technology machines, graphic design cards, and different ways that we can really communicate with these different sectors and types of stock. So we got the market capital, which is basically the amount of money that's enabled to get inside the stock right now, or how much money is flowing in and out of that stock at that time. So market cap is like overall amount of size of money worth that stock is, or company. So we got the mega cap is over 300 billion. And then we got the large cap, which is over 10 billion. And then the mid cap is 2 and 10 billion. And then we have a small cap, which is 300 million and 2 billion. We got a micro cap, which is 50 and 300 million. And a nano below 50 million. So the mega cap is what you want to really look at based off that company, because that's worth a lot of money. But those stocks tend to be a bit more risky. That's because the more money that has inside that company, or the more value to that stock is, it has a chance of more risk and reward at the same time. So you want to look at those if you're looking for maybe a profit, drastic faster over time, and it comes with more risk compared to the nano stock that is real low, and it could be risky as well, as high as the mega stock as well, due to because the volatility is low, but it takes one move for the whole stock to like make one bad decision, because there's not a lot of money to cover in the stock. Then we have the micro stock. And then that one has 50 and 300 million, which is still a bit risky too, investing in those type of stocks. So I always look at mega caps whenever I look into buying stocks. There are many reasons why you should buy and trade a stock. You can beat inflation investing in stocks, grow your wealth, and earn a second income. Make money trading for a living at home or across the world, different parts of the country, and generational wealth is number one. Building capital for large investments is what stocks are mostly used for. So if I have an amount of about 5,000 set aside, and I have my bills covered for the next 6 months, and then I paid off all my debt, I don't have any extra payments I'm making outside of my expenses. I have a budget. I have about 1,200 of rent accumulated, all for groceries, rent, and utilities, and any extra expenses I already have in my budget. So about maybe 1,500 to 2,000 I spend on everything a month. And then we add this all into a spreadsheet, and we have able to pour into investments. And we number one tool, which is our building will tool, is our income. So if we can get our income set, and then we can increase it over time with our careers, then we are already steps to making ourselves a millionaire. So stocks is a great way to use that tool besides our budgeting and our tool of income, and make bigger investments. So that 5,000 we can put in during the dips in the stock market, when S&P 500, NASDAQ, Dow Jones crashed about 10% to 30% in the last 3 months. So now we got that 5,000, and we know that stock market over a time goes up exponentially. So we put that 5,000 down in that dip, And now boom, we see our investment go from 5,000 to 30,000 in 6 months or 3 years. So that's what this important is of the stock market. And that's why we buy and sell stock. In order for you to own and buy a stock, you need a brokerage. You need to download Robinhood, TD Ameritrade, or Fidelity, and then you can start uploading your ID from there, and then you have to get verified. Once the verification process is complete, you can transfer funds into your brokerage account. Once you transfer funds to your brokerage account, based on how much you transferred, if you only had $10 to transfer at the time, you can add that money into a stock and get a percentage of that stock. With that $10, Tesla was $250 right now, you wouldn't have to buy the whole share. You can add whatever money you had in there and then get a percentage off based off how much you invested at the time. So now this is how you can accumulate wealth over time, by continue adding the amount of money that you have aside and continue buying shares of different companies. There are many misconceptions about ways you can profit from a stock, and people only think there's only one way. There are many ways you can profit from a stock. One of them is being able to buy low and selling it higher. The next one is buying it high and selling it higher. And there's many ways you can profit too. I'm gonna give you another example, like selling high and buying the stock lower if you're doing a short position. But we're not gonna talk about much this video, so we can dive straight into the introduction of the stock market. And you Disney guys need to know these two if you're gonna be trading or long-term investing. This is the best way that you can get it. As an investor, it's important for you to know how to calculate your profits. The brokerage always shows you your gains and losses, but it's always important for you to know how to get that number. So first, you must get the number of shares, and then you multiply that by the difference between where you bought the stock and then where you sold the stock. And this is gonna get you your gain or your losses. So if you sold your stock at a higher price, then you're gonna always be profiting. If you sold the stock at a lower price you bought it, then you'll be losing money off the stock. It's the same thing with investment. If you sell your car less than where the value was at, where initially the market was at 10,000 where you bought the car, but you sell the car for 5,000, then you sold the car for a loss of 5,000. And this is how the stocks movement works too. If I bought Tesla stock at $100 and I sold Tesla stock for $500, then I sold my stock shares with a profit of $400. So every stock share I own, if I had 10 shares, then I would get $400 every one share I own. So that's 400, 400, 400, 400, 400, 400, 400, 10 times. But that would be about $4,000 I'd have made off Tesla by just buying at $100 and waiting over time for Tesla to get to $500 and appreciate. Then that's how stocks work. That's how you calculate your profit. These are the common trading terminologies that are used in the stock market. Long means we're seeing prices go up over time and we're expecting prices to project higher. And we see that this happens whenever there's good economic news or data like job reports or good earnings, or there's good news for the company in general. They might have a new partner or they didn't freeze up some cash and debt. And now we have shorts. Shorts are whenever some of the profits from the stock going down. We have seen this with the tariffs that Trump put on these different countries and how these are affecting the economy. Now people are selling their stocks and stocks are going down. We have a bid. A bid is the highest price a buyer is willing to pay for a stock. We see like someone wants to buy Apple stock for $170. That's the bid. If we see the ask for a stock, then that means the lowest price the seller is willing to accept. And this is someone that is willing to sell Apple stock at $170. That's the ask. The spread is the difference between the bid and the ask price, which is like the formula ask minus the bid equals spread. Use an example, $170 equals a .10 spread. Why this matters, a tight spread, it usually means that there's higher liquidity, a lot of buyers and sellers. A wide ask spread. What is long and short? In the stock market, we trade off price direction. So if long means that profit goes up, that means I projected that the stock price at Apple I bought at $100 went to $170 the next 2 months, and that profited from a long position. Short is when the price goes down. The price crashes and loses the value of its original price of when you bought it. So now we see that short positions like now are very in demand as these terrorists and economic fear, people are selling out stock positions, taking their profit. And this is a healthy sign of the stock market whenever you see long and short positions, and one of them are really profiting during a special time, and then the other one is really profiting at a certain time. There are different types of orders you can make based off strategy. You can put in a market order which fills in your current position at current market price. So if I put in a market price at Apple for $100, and Apple is currently at $100 right now, my market will fill in for a market order of $100, and then your market will get in on your shares. If you can put in a limit order which fills your position in at a certain price, and then you can get those shares at that price. Now, a limit order doesn't always get guaranteed filled unless the market is currently hitting your limit order. So imagine it like you're setting a little bar. If price doesn't go towards that bar, then your order may not get filled by the end of the day. So if I buy Apple and I put a limit order at $105, Apple is currently at $100. Apple will need to go past $105 or at $105 to get my order filled in. Meaning $90 or $92 or $101 will not get filled then during that time. A stop loss is whenever you use a loss or a get out position whenever you own a stock or trading a certain position to get out to avoid losses and necessary risk. So I put a stop loss at Apple at $90. Well, current market price at Apple is at $100. Well, if Apple goes down below $90, I will leave that exit in that position and get my return, sell my shares, get my sell loss for that day. This is what traders do so they don't lose. They don't have to lose a whole bunch of money in their portfolio. So let's do a quick review. Market order. You enter the market now. The pros is you sure will get in the trade or position at that price. The cons is you may pay premium depending on your broker, but we don't pay attention to things like this. We're investors. Premium or any extra cost that we pay for the stock and brokerage is not in our concern because we're investing long term. Limit order. Enter the price if the market comes down to your desired price. The pullback. The pros is you enter at a lower price. If I want to buy Apple at $90 and Apple's currently at $100, then I'm gonna have to wait for Apple to go down to $90 to enter that position. Cons is you might miss the move. Apple may never go down to $90. But sometimes you always want to be careful because this can hurt against you by trading against the current momentum. If Apple goes below $90 and it gaps down to $85, from there you're losing money and you can acquire losses. So you just always want to use a limit order cautiously and the market order depending on your strategy. The stop order, you enter only the market moves in your favor, the breakout. The pros is enter trades with momentum. And the cons is you might be in a false breakout. So price could break out after you sold your position. And that's what always gets people with a stop loss, because the market just could be doing this fluctuation or bottoming out at the time. And we're having doubt in our strategies or just having fear in our strategy. And that might make us put a stop order in. And then the cons is it could be a false breakout. And this could help you sometimes whenever you get out of position before the false breakout. The stop loss order. This is whenever you exit the trade if the stock goes against. The pros is you cut your losses. It's always important as a trader or long-term investor to have a stop loss order, meaning a price where you get out the trade that goes at that level or even below it. You're going to exit that position so you don't acquire a lot of losses. And this may be important whenever you're doing strategies like day trading, swing trading, or even position trading. Price goes against you in your strategy, you always want to make sure you're being aware of it, caution and bearing on risk, and most importantly having a stop loss order to protect your portfolio from being blown and damages. The cons is the market may reverse back in your direction. So that's another thing. If you have time, stocks tend to rebound over time if they do acquire huge losses. So you always want to put that into effect before you put in your stop loss. If this stock goes against me, is my risk tolerance enough? So if I get out this position now, will my position benefit and run over time, or this is it? I just need to take my stop loss now and just take it over with and take that loss. So these are things that you want to consider based off your strategy. The market may reverse back in your direction, meaning price may recover before your stop loss. But if you put your stop loss in already, then you done accepted the loss and lost some of that percentage of that profit, your capital. Let's dive into technical analysis. Technical analysis consists of trends, volume, volatility, and data analysis. So let's look at support and resistance. Support and resistance is whenever we draw a horizontal line on past prices where prices touch that horizontal line the most. So we have area of value, meaning there's buying pressure and there's selling pressure. And the stock market always has supply and demand, and where prices touches very frequently. So prices tend to have patterns of different ways it moves. So prices like to fluctuate like stairs and then come down and then go up. And they also have volume. Volume is market patterns on different amount of people who are buying and selling the stock. And this is what moves price directions and candlesticks and lines. This is what you see, but then first have to have volume behind it. People buying and selling and putting money in the stock market. You always want to pay attention to the volume too, compared to the candlesticks, because volume is what increases these candlesticks to move faster compared to a company or stock that has less volume. So always keep and write this down. Volume, high volume means more volatility, more movement in the stock market. It means more risk as well. It also means more reward. Less volume means less movement in the stock market, less risk, and it could be more risk as well, because it's one time the volume might go either way in one direction, towards the downside or upside. So you really don't know if it has less volume. Sometimes it could just be in a range, meaning the stock basically is not going to move. If the stock has less volume, it's just going to stay in the same place, maybe go up a little down, but it's not going to stay out of the range. A range meaning between one price and one and another, not going out of that boundary. A trend is a tool people use in the stock market to analyze who's buying and who's selling and ways they can profit in the stock market. It's the easiest strategy you can add to your bag, and it consists of higher highs and higher lows. You see that this stock right here had a low of $362, and then we see the stock go up to $439. This means that the stock had went up, and then it kind of retraced down to the downside, and then went up again, and then went down, and then we kept doing that, consisting of higher highs and higher lows. And we noticed that the bottom over here, that they had a floor. Every time that price fell down to this floor, price quickly rose up, and rose up, and rose up. So this is what we see, an uptrend. We call this an uptrend in the stock market, and we're always going to look at areas of support and resistance, meaning if we put a horizontal line right here, price will touch it that at least 3 times, and then we put a horizontal line right there, then we see price touching 1, 2, 3, 4 times. So we're just seeing prices touch our support level and break out of resistance. The resistance is always going to be the top, and the support is going to be the bottom. And this is whenever the bulls are in control, meaning buyers are stepping in, they're buying at these areas of support where price touches the floor, and then they sell it at the resistance whenever it goes higher. And the lower highs and lower lows is what we see in the bear market. The bear market is whenever sellers are in control and they're pushing the prices down. The bulls always want the price to go up over time, and the bears always want the stock market to go down. So these two are always combating in the stock market. That's why we're seeing fluctuation in prices. We might see prices going down, but then people might come and step in and buy that price and push the stock price up. So we're just seeing these two fight. But as an investor, me and you are just taking advantage of these two during their battle and stepping in at the right time so we can see who won that fight clearly off who fought and who won that battle. The bulls are in the uptrend and they won that battle, and then the bears won that trend, the downtrend. So now we see they won that battle and we can profit with them. Now let's dive into the bread and butter we see inside these trends in the stock market. A candlestick is a way you can increase where you buy and sell and profit over time. A candlestick consists of a solid part, the body, and 2 thinner lines, which are called candle wicks or candlestick shadows. The candlesticks are color-coded to show the direction of price movements. A green candlestick usually represents rising prices, whereas red candlestick shows that prices fell during that time. Let's take a look at this diagram at the top left. We see that price opened at the bottom, and then it had a range. It had went up during the time of that candlestick, which is the high of the range. And then it's actually right here showing the wick of the candlestick because prices didn't stay there, and the price closed up here for that day, meaning price opened and then closed higher. So this candlestick shows price rising due to where the movement went from the bottom to the top. Every time we see something going up, we see going from the bottom to the top. That's what projecting. So if we can get the stock having to go up like this, we can see candlesticks are moving over time. But in the uptrend, we're seeing these red candlesticks as well, meaning stock opened at the top of the range and then it went up higher, but it couldn't stay up there. The bears pushed this price to the downside, meaning it closed at the downside down here. And now we see these are green and red candlesticks. How to tell if a candlestick is bullish or bearish? Let's take a look at the gravestone doji. We notice that first, before we look at these gravestone dojis, that these have long wicks, meaning where price was opening for a low price and a high price for the day. I always want to see where the wick is compared to the body. So let's look at this gravestone doji. We see that the low price of the day was down below right here, and then it rose to a high price towards the top, and then ended up closing near the bottom. Bulls pushed the price towards the high price for that day, and then bears quickly pushed that price back down because the bulls had not enough strength, and the bears won that fight, and they ended up closing. That means price fell during that time toward the bottom. So the next candlestick, we see price open from where that price closed that day and had a low price down here, and then we see that price had a high for that day up here, and then the bears quickly pushed that price towards the middle because the bulls had enough strength. They didn't make it push all the way back to the downside. They ended up closing for the middle that day. So this is a good sign to look at whenever we see indecision in the market or trend reversals. The key candlestick to look at right there. Dragonfly doji is whenever we see price open from the top and then go down for that day and then go back towards the top for that day to close towards the high price. This is a good bullish candlestick to look for, and I like to see these whenever we see bullish or high prices going towards the moon. Strength of a bullish and a bearish candlesticks on this diagram, we see that the left is more bullish and the right is less bullish. So look at this engulfing candlestick right here. We see price go toward the bottom, open, and then quickly push up, close toward the top, leaving no wick behind, meaning this wick is showing where price was projected or signaled. So everything in this candlestick was straight this body, meaning price opened at one price, closed in the next. This one is showing where price opened there in the bottom, and then we see price quick moves up to the top and then end up closing there at that pricing candlestick right here, open towards the middle, go down price, and then end up going higher, but they couldn't stay up there, so they end up showing closing in the middle, which is the indecision candlestick like the long-legged doji. And we seen this gravestone doji looking candlestick too, where price opened in the middle down here, and then it went down, and then it ended up closing back up here. But price touched up here during that day. It just couldn't stay up there. The bears pushed it down here. So we're seeing we're getting less bullish, so we're going to the right. Price open towards the bottom. Bulls pushed the price up, but they couldn't stay up there. Price ended up closing back down to the bottom. That's a bearish candlestick, but it's still green. It's still showing that the bulls didn't have enough strength. This is the most bearish candlestick on the left, and then the more bullish candlestick on the right. So we see that this price up here opened at the top, and the bears pushed the price all the way back to the bottom, made the price fail. Now we see that the next candlestick price opened at the top, price fell down real low and ended up closing towards the bottom. And then we see this candlestick price open towards the top, price went towards the bottom real low, and end up bulls pushing it right into the middle. They didn't lose completely. Then we see the gravestone on the long-legged doji on this candlestick. Same thing we seen up there. There's price open at the top, close, or didn't close it. It could try to go to the bottom and ended up closing right in the middle. And then we see this bearish hammer price was at open up the top and then hitting the bottom at the day and then ended up closing there at the top. So this is showing bullish candlesticks right here. Same thing with this dot. We're seeing the price open towards the top, go towards the bottom, and end up closing there at the top. So this is a real bullish. These two candlesticks are bullish candlesticks, but they're red. So that's why you always can't look at the color of the candlestick, because you just always want to pay attention to where the body is compared to the wick, because the colors can be confusing for you to see where price is headed during that time. The candlestick body relative to the wick. During a strong trend reversal, the bullish candlestick bodies are often significantly longer than the wick or close near the high. This is we see example like a hammer, a bullish engulfing, or a dragonfly doji. And on the left, we see a diagram of a bullish candlestick where price opened during the top. It actually fell during that day, but price ended up closing near the high, predicting where it opened it opened and closed higher where it did open. And then we see the shooting star. This is when the trend slows down or reverses. The wick becomes longer compared to the candlestick body near the low. We see this is a candlestick shooting star, a bear engulfing or gravestone doji. And we'll see the gravestone doji or shooting star right here in the bottom. Price was opening at the bottom right here and ended up closing higher, but actually went up real high, but ended up just closing higher than where it opened. Still a little bullish, but not as much, because we see that the bears had enough strength to push the stock back down. We see the engulfing candlestick, meaning it's past the low or high or the previous candlestick, indicating a trend reversal. So these are very strong candlesticks that you want to see in key areas of support or resistance. If the size of the candlestick bodies increases over a period, the trend price accelerates. So we see that price starts to move with these big body candlesticks. And then we see that right here, price opened at the bottom and it ended up closing at the top. And this is a bearish candlestick on the right, where price opened at the top and then price quickly fell down. And then we see that price is starting to move down towards the downside and lose value. And then these red candlesticks, we see that the strength of bearish candlestick engulfs the previous other candlestick where price opened and went up towards top. And then we see the one on the next right. So candlesticks go from left to right. So these candlesticks going down here towards the downside, and this candlestick quickly just pushes the price back up, with this passing these other previous two candlesticks. So this is a good type of candlestick we see whenever we see prices trying to reverse or trying to go back to the upside. The three black crows is whenever the bears push the bulls out the way and they take control. The price gaps slightly up, and then the bears push the stock price even down. So we see that the stock was open here, down here, open at the bottom, closed during the top. The next one open at the bottom, closed at the top. And then now we see the stock open at this top right here, which actually gapped down, and stock prices can do that. And then we see the stock can go down right here on this one candlestick, and the next one we see the stock price go down, the next one as well, and this next stock go down as well. So now we're seeing prices gap towards the downside, and this is why it's just the three black crows. The three inside up, this is a reversal pattern. We see the second bar is smaller and indicates a pause or end, and then the final bar shows changing momentum. Whenever we see those engulfing candlesticks in key areas on our stock charts, this is a sign of three inside up with these three candlesticks. So we see these now trend reversals, and they're very important to look at towards the bottom of the stock. And we look at the stock right here go down, and then the next one open at the bottom, quickly rise up, and then we see the next one open at the bottom right here, and then quickly projecting price. This is a good sign to look for whenever you see stock going down and have a huge sell-off, and we're looking for a trend reversal. Another word I use a lot in my videos is the corrections, aka pullback. This is a short price movement against the current trend direction. During uptrend, corrections, aka pullback, is whenever price falls. Price does not move straight in a line like this. Price has to gap up and then go down a little bit like this, and then gap up and then go down like this, and then consolidate and then go down a little more and then go up like that. So we see that price doesn't move straight in line. This is a misconception I had whenever I first started, and this is a way that you can avoid that mistake. And we see that this Emma stock on the left is a good, perfect representation of this. We see prices going down, going up, going down, and then boom, hitting an area of consolidation or range, and then we see higher highs, and then we're starting to see more breakouts with engulfing candlesticks. If we were to zoom in, we've seen those hammers and those engulfing candlesticks in these graphs. If you had 1 hour, or if you're at a different time frame, you can able to see that. Now let's dive into another arsenal that you can use in stock markets to increase your profits: the chart patterns. This is where we see a downtrend phase in the stock market, and we see that our sellers pushing up and pulling the stock down, and then we see the pattern connector, which is called consolidation, meaning price stayed in a range. And if you put a horizontal line right here, you see price doesn't fall below or break above that range. And then we see the uptrend where price finally starts to break out that range, and we see it go up towards the upside. This is called an uptrend. Now, this is right here, a double bottom, where we see that phase again, where price sold off, and then we hit that range again, that consolidation. It hit this first bottom right here, and then exactly touch that second bottom. But nowadays, we see stock prices don't hit this double bottom. This is a perfect way where people lose money, because people see a perfect double bottom like this, but then price can quickly reject lower like this. And we've seen that many times in the stock market. If you're an experienced trader, let me know if you've seen that move where it breaks down below, because people think that's a perfect double bottom, and maybe hit down right here and then it bounce back up. And then we see the triple bottom, where price touches the bottom 3 times right here, which is pretty much the same thing I showed you guys previously, and then price breaks up after the third time the charm. The entry trigger is important whenever you look at stock chart patterns, and you will look at candlesticks like bullish engulfing, bearish engulfing, and a shooting star or hammer at these key reversal patterns. So let's look at the double top. The double top is whenever price rises and then it hits one top down here and it quickly falls back down and hits another top right here, and then the bears push the price all the way down. And then the head and shoulder is whenever we see the price going up and the buyers are in control on our left side, and then they hit the area of resistance, the price falls down, and then the bears try to push it up again and reach a new high, and then now price goes back down, and then the bears, they quickly take back control after price rolls again, and which is the second shoulder right here, and then the bears push the price all the way back down. We make it a head and shoulder. We see the head up here and the shoulders up in the right and the left, and the rising wedge is whenever price is up, and then the bears quickly push the price down a little, and then the bulls try to poke it back up. Bears take it back down, indicating like a little triangle pattern right here, and then bears push the stock price down. And then the double bottom is whenever bears push the price down, bulls push it up in this nice little range, and then hits the second bottom right here and the first one right here, and then price pushes back up. And then we got the inverse head and shoulders. This is like a bullish candlestick down here. This bullish chart patterns on the bottom, where we see stock prices fall down, and then they stay in this range and then quickly break out of that range. You see these type of inverse head and shoulders all the time in the stocks. And then the falling wedge is another good one too. If we were to draw a triangle right here, stock would break out on the right side after completing this range. The continuation pattern is a falling wedge, where we see bulls push price up, and then the bears push price down in this nice little area of support, and then they break off and it projects higher right there. Same thing with this one. Price is projected up, the bears make a nice little squared bullish rectangle, and then they quickly push the price back up after consolidating. And then this is a bullish pennant, where we see stock price checked up like this, and then we see a nice little put a triangle in this stock price. This stock breaks out. This is like a bullish flag basically. The rising wedge is whenever we see the stock price going down, and then stock consolidates like a little flag pattern, and this is like the reverse flag pattern right here, and then stock goes down. The bearish rectangle is whenever stock's going down, it has another nice little rectangle box right here. You'll put it in a consolidation, and then stock price falls again. And then the bearish pennant is whenever stock hits this nice little flag again, but boom, stocks crash back down. So these are all nice, good patterns to look at. The bilateral pattern is whenever the stock is rising, and then it consolidates, makes this nice little triangle, and then stock bounces up. So this is ascending. You got the descending triangle, stock price is going down, and then hits nice little triangle where stock consolidates and then stock falls down. So the symmetrical triangle is whenever stock's rising, it hits nice little consolidation. You can draw a triangle or horizontal box over it, and then boom, stock price breaks out. The number one thing as an investor is calculating risk. Whenever you have risk management, this is going to save you from huge amount of losses and file for bankruptcy. So the way that we calculate risk management is the win percentage, the risk over the reward ratio. So this is an example of a person that has good and bad risk management. Person with great risk management is a person that loses at least 1% of their account or portfolio over time, and they don't risk more than 1% of their capital. So we see Doe risk 1% of his capital, and he lost. First time he trades, he lost 1%. Another one, the next day he traded, he lost another 1%. And the next day he tried to invest, he lost another 1%. And then we see the next day he won at least 10% the next trade, and then won the next trade 10% again. So now these next 2 days, he done made up for all the losses that he invested in, basically only risking 1% of his capital. So this person's always going to be making money over time. I'll take an example. Based off his first 5 trades, we know that if he continues this habit and it continues losing the next 2, like he lost 1% again and lost another percent, that he's going to be making more money than he loses, compared to a person who risks 50% in his trade like John. You don't want to be like John, guys. You don't risk 50% on his first trade and blew up half of his account. So he had $10,000 invested and already lost $5,000. So John has to make some readjustments, but hopefully he gets it by his second trade. So he trades his second trade, and now he loses another 50% trade. This person is not going to be able to invest onto the stock market. As a matter of fact, they're going to be burning all their money time they touch a stock or they trade a stock with this type of risk that they're putting on in folio. So we noticed that the first 2 trades that John is out of the stock market, he no longer can invest compared to Joe. Joe keeps his risk low, and he has many times attempts to seek profit and take profit whenever he invests, because he keeps a 1% loss in his portfolio. And if he lost 1% of his portfolio, it's $10,000. He will be only losing at least $100 each trade, compared to John, $5,000 each trade he takes, and he's only able to take 2 at the time and lose portfolio. Successful investors know how to calculate their risk. You can't be a successful investor or trader if you don't know proper risk management. Risk not more than 1% of your capital trading. No matter how good your setup is or how much percentage you have guarantees of profit, economic factors do play in, earnings report play in, and things like false breakout always you have to consider whenever you trade or invest. Have a proper risk management by cutting losses short if the trade goes against your strategy. If you're a long-term investor, then don't even worry about losing your income or having too much of a risk profit. But always make sure you can always increase the chance that you enter a stock or your buy price, because the lower the stock price that you buy, the less risk you are compared to someone who bought the stock higher. And it's always going to be like that. Now let's dive into the different type of trading mechanisms we have and what kind of trader you are. So it's always important to know what kind of trade or strategy we have before even buying and selling the stock. So let's look at the day trading and the swing trading and the position trading in the next few slides. The day trader trades below the 1 hour time frame, and they capture intraday volatility. The pros is you can be profitable on most months. The cons is a lot of psychology, stressful, requires a lot of screen time and high opportunity costs, meaning there's a lot of risk in day trading. Because whenever trades go against you in the day, you usually sell your position for the loss. And this is a good thing about day trading, they don't carry on losses for the next few days. So if the whole market was falling down the next 6 days in a row, like we seen this week with tariffs, we can see that even though the market was selling off, these day traders can turn it around and start continuing the trend with this sell-off going on and intensifying with the tariffs fear on the market. And they can bring a huge amount of percentage in 1 week potential with the options that they're trading, with the profits that they make from stock going down. So day trading has its benefits and has its cons, but you just gotta know where you stand on where the trend is and the stock is. That's why we learn trends and candlesticks based off the day trading strategy. Next, we have the swing trader. The swing trader captures moves between the 1 hour and the daily time frame. They capture one move in the market and they're done. They have pros like they're less stressful and they don't need as much screen time. I mean, they buy one price one time, and then once they see a quick swing, they quickly sell and then they're done. Cons is the market can be more drastic moves overnight. So sometimes swing traders hold positions overnight, and they might buy at a price and then wait for the swing to happen overnight. And this can be very risky, as overnight stock moves can move drastically based off economic news like tariffs or earnings reports or inflation data. Anything can move the markets overnight that can make your move go against you. So that can be one risk of a swing trading type of strategy. And it's always good to know when to use these type of strategies. The last one we have is position trading. This trader trades between the 1 hour time frame and a weekly time frame. They buy and hold until the trend reverses or shows weakness, months or years. And the pros is the less amount of screen time and it capitalize off trends and huge potential awards because they capture from one price like $100 and they capture moving all the way to like $300. So their profit maximizes more due to they have more patience and they wait to carry out the whole move even during bad economic times or bad price movements, and then whenever it consolidates or it corrects, they're still holding on or buying more. Well, this is one of my favorite strategies I use is position trading or even long-term investing because at the end of the day, long-term investors do need to take their profits in order to rebalance their portfolios. And I do recommend using some precision trading in the right economic state, in the right trend as well. The economy requires patience and potential overnight losses. You know, I said that overnight there is some huge volatility sometimes, and earnings do, you know what I'm saying, fluctuate prices after earnings reports. And there's 4 earnings every time in the quarter. They have the first, second, third, and fourth quarter. And based off those quarters, these companies report to price moves drastically. Thank you guys for staying to the end of this video. That's going to cap it off for this video. I hope you guys enjoyed the content I provided for you and information for you to get started trading in the stock market. There is more information for you guys. In the next video, I'm going to teach you guys about options trading. And this is going to what you need to know as options traders after you started your journey as a stock investor. This is the next step for you guys. This is where you guys are going to make a lot of your bread and butter, a huge amount of capital, and investments where you can grow your investments to make that next type of business for you and your model. Make sure you guys like, comment, subscribe. Make sure I see you guys in the next video. I love you guys. We're going to see you in the next one. Thank you guys again for the support that you meant. See you guys in the next one. We out.
I stole my love and make it countless. I've been in the flu, but I never drowned it. Life is tough on a simple bounty. Faith in the Lord, I never move a mountain. As I sow, I shall reap. There's an outcome to our deeds. So I practice what I preach. Yeah, I'm covered in the spirit. From my head to my feet. What I want is not a need. She keep begging me to stay. Something's telling me to leave.